I know some of you are, so I just want to get a sense of how much of the basics to cover here. How much of you, how many of you are not familiar with this tool, the triple squeeze, or this tool? Just if you just want to say, hey, I no clue, they'll just give me a sense of that. Okay, I just want to make sure. Okay. So what I want to do is, now some of you I know you are, I know some of you are familiar with it. So what I'm going to do is I'm going to go through and just kind of give you the basics of what this is, why it's important, and then from there, how to use it for both income trading as well as directional trading. And then towards the end, we'll look at some examples that we can set up for tomorrow. Okay, so perfect. Okay, fantastic. So let's just dive right into this. Now, when we first released these indicators at the time, and this was, I think, the beginning of March, maybe end of February. At the time, my account that I used for my trading room was up 98%, and just said, hey, I like to just say, like, this is what's going on, this is what it looks like, et cetera, et cetera. And then by the time that we actually did the first release of these indicators, the account continued to grow. And at this point on March 19th, you can see that the net liquidating value is $263,000 starting. So you got a starting balance of 117, trading profits of $152,000, less commissions of $6,500. That leaves this, which is a return of 118%. So great. So that was a month ago. And so now the question is where are we today? So I just took this screenshot, and this is where it is today. So now, I forgot, where was the balance? So the balance was 263,000 on March 19th, profits of 152. So now here we are on April 19th, the balance is 394,000. So certainly an appreciable increase. Total profits, instead of 152,000, 287,000. So I mean, I started at 117. I haven't done the math on that. I guess is that a triple? 117 times 3, 7 times 3 is 1, 2, 3, 5, 3. So yeah, a little better than a triple. So so far so good. And again, you'll notice that. Well, here, let me just grab my. Like right now, this is my live account. There's the clock ticking and everything like that. So a lot of these trades right now are non-directional. Okay, NVIDIA is a non-directional trade, but CMG is like, man, when something like this sets up, go for it and knock it out of the park. And so this tool has just been helping me with that and making that easier. Okay, so that's what I wanted to just talk about that and stuff like that too. So, all right, so the key with this and to understand is that this is not, I mean, if you guys remember whatever that was, January of 2014, I, loaded up on Tesla. It was a very unique situation, made like $1 million in a day. I mean, I'd love to be able to do that again, right? But that just, when that happens, you can't plan for that. And, this year there hasn't been like some monster trade. It's not like, oh my God, look at this one big trade I made my entire year. No, it's what this has been base hit, base hit, base hit, triple, base hit, base hit, base hit, base hit, triple, that kind of stuff. So, and it's not about buying the dip. We all know that buying the dip works until it doesn't. Okay, there's up trades, down trades, sideways trades, and this market has been up, down, and sideways. And the key is just to be able to identify what kind of market you're in and adapt very quickly. All right, it's been about steady winners, and most importantly, and this is the toughest thing I've seen with people, at least in the trading room, is that it's cutting losers off at the knees, right, when they're not working. Okay, utilizing setups that continue to give an edge over the machines and the market in general. And so the question is like, okay, how do we do that without going crazy? How do we do that without having, because I don't like having like 15 positions on. That just drives me crazy. So how do you do that? So, when you do have a big trade, this is again back in January 2014, it's like, wow, that's great when it happens, but you can't count on it. And frankly, it's an emotional roller coaster. Okay, that's hard. And so that's not what I'm looking to do. Look, if it happens, great, but that's not what I'm expecting. Okay. So what I'm expecting is to create an equity curve. And really, as a trader, you can just define yourself by your equity curve. Okay. If you start here at the beginning of the year, and you end, at the end of the year, you're here, right? Or you're here, or you're up here. And the question is how did you get there? Was it something like this? Okay, well, that's stressful. Okay. Was it like this? That's no fun. Was it straight like this to zero? That's no fun. Or was it just kind of a nice, steady, with a couple of pops here and there? And that's what we obviously want. And we've got to have the right tools and frankly, psychology to get that. So this market, I've found that it's been tricky for a lot of people, but I think it's actually been pretty smooth sailing this year. And what I've found with this market, especially, is that it's just critical to understand and know how the institutions currently work. Okay, how are they working this market? Okay, because what happens in this kind of stuff is that we got to understand how money flow impacts the large stocks within each sector. All right, when the indexes are taken over by the machines, sideways and sloppy, okay, versus when stocks are free to adjust to new price levels, and those are the moments that we want to identify. Because right now, what happens is sideways and sloppy is actually more intense than it used to be. All right, and but then when stocks move, they move more quickly, and so you don't have enough time. A lot of times, if you're not aware of the changes and don't know what to look for, you don't have time to adapt. So the key has been to find stocks that have a strong correlation outside of the markets. Okay, that's an example of CMG. We've seen it a couple times this year with Chipotle's, with Tesla. For lack of a better term, it's kind of like a honey badger type stock, or to find stealth moves within the key sectors playing on the same field as the institutions. Okay, and we just want to know how to do that and why. So at the end of the day, too, I'm not a big fan of complicated strategies. Okay, I like to buy a call, buy a put, or do a spread, and that's pretty much it. I don't do a lot of broken wing butterflies or things like that. I like to keep things simple. When my mentor that had the most impact on me when he trained me, he focused on direction. So my general rule of thumb is to focus more on direction. And then from there, just wanting to use tools that are, with easy. And I started off, trading futures and stocks. And so I wasn't into premium and all that kind of stuff. When you buy or sell a futures contract, price is price. When you buy or sell a stock, price is price. And with options, it gets a little tricky because you could buy a call and a stock could go up, but you could lose money if you, did something wrong with it. So I love options, and most of my trades these days are options, but you got to know how to, utilize them. So the setups that I like have a premise of, buy the call if you think it's going to go up, but with the ability to accelerate returns with tweaks, such as adding a spread. Okay, but in this market, if you're only looking at the chart of the stock that you're going to trade, you're being set up to get run over by the institutions who are more focused on sectors. And by the way, it's the sectors that are driving this market. Okay, so why is this important? So this is important because, first of all, there is no need to find the needle in the haystack. This market can be remarkably easy if you know how it works and how it moves. If you don't, it's going to be very frustrating. And to understand this, you've got to know what the big money is doing. If you're fighting the big money, you are not going to make it, okay? And the worst part is that a lot of times people fight the big money and they don't know they're fighting the big money. It's kind of like, if you were getting ready to cross a freeway and saw a bunch of 18-wheelers coming down the road at 80 miles an hour, you'd wait until they passed. Okay, it'd be very obvious. It's like, wow, they're right there. But in trading, if you don't understand how to find the semis or how to see them coming, you're just going to get run over. So the other thing to understand is how they trade. So are they day trading? No, institutions don't day trade. They leave that to the high frequency traders. Okay. And by the way, I do not even look at charts under 5 minutes because the high frequency traders own those charts. I'm not competing with them. I don't have computers trading, in 1/1000th of a second. So we want to find a niche in there that belongs to us where these guys can't, hurt us and we can mimic their actions. Okay. So what are they doing? So here's the big money. The big money out there is chasing the same stocks for one simple reason, and is that they have no choice. All right. Now we're going to look at a stock, CMG, and a couple of other ones. The institutions aren't really chasing that one. The volume isn't there. They have got to have volume. There's so much money out there. They've got to have volume. So here's the 10 main exchange traded funds that make up the S&P 500. You got consumer discretionary, consumer staples, energy, financials, healthcare, industrials, materials, real estate, tech, and UTS, okay, utilities. And you can see that the volume on all of these is fairly healthy. Okay, financials, huge. Tech's a little lower just because a lot of the big tech stocks like Microsoft and things like that, they have a good volume, okay, but a lot of other stocks don't. So what happens here is that this is what drives their returns, is they're rotating in and out of sectors versus loading up on a stock. Funds are so big, like they can't even own more than like 1% of individual stock due to liquidity. So, you know, a fund could have owned Amazon for the last 2 years, but it only represents 1% of their entire portfolio. So it's not going to actually have a huge impact, okay? But they can rotate in and out of these sectors, okay? So why is this important? Well, you can clearly see here on slide 11, the sector rotation, okay? So if we look over the last 1 year, okay, you can see that, wow, money poured into financials, okay, but not a lot going into healthcare. And in some cases here, they were selling healthcare in order to pour into financials. And this happens all the time, okay? And we've got to be on the right side of this, because if we aren't, we're going to be blindsided. So the other thing to keep in mind here is that the key sectors as a percent of the S&P 500. A lot of times people say, oh yeah, the S&P 500 is so balanced. It's not. That's a lie. And if you look at this, tech, okay, represents 24% of the S&P 500. It used to be energy, but energy has gotten destroyed. So now energy only represents 6% of the S&P 500. I don't know if you knew that. Financials are 15%, okay, et cetera, et cetera. And so if you look at this, these 4 sectors right here, healthcare, consumer, financials, and tech, represent 65% of the S&P 500. Guess where the institutions are focusing on, because they have no choice, all right? So the bulk of institutional money chases those sectors simply because that's where the liquidity is. So even better. So this is the part where it gets really exciting. And if you look at this, okay, so you got XLK. So these are ranked by size in relation to their in relation to the S&P 500. So XLK is tech, represents 24%. Okay, XLF financials represents 14%. But look at this: the biggest stock in XLK is Apple, and Apple represents 14.9% of XLK. Remember, XLK represents 24% of the S&P 500, and 15% of that is represented by one stock, and that's Apple. Another 10% is represented by Microsoft, another 7% Facebook, and then you got AT&T and then Google, okay? And if you just go down the list, you got Berkshire makes up almost 11% of the financials, JP Morgan almost 11%, right? The one that I like, and this is kind of stealth, is you'll see XLY. This is a consumer discretionary sector. And what's the biggest one in there? Amazon, okay? And you'll notice the 5th biggest one is Priceline. Now, this is important to know because a lot of times people think those 2 stocks are tech stocks, but guess what? They don't move with the tech sector, they move with the consumer sector. Why? Because when funds are rotating in the consumer stocks, they're buying XLY, and then the XLY has to go out and buy all these stocks on a weighted basis. All right, so it gets, again, not super critical to understand the hows and the whys and the whats and the mechanics. But you've just got to understand how the market works, okay? And you've got to understand that money flow, I mean, pretty much, you know, most of the money flow out there is taking place right here, okay? Now, you'll notice that there are stocks that I trade that are not these stocks, okay? And that's more for stocks that are going to make an expected move. But guess what? Most of the time, these stocks won't make a larger than expected move because the institutions have an incentive to keep them in a range or moving steadily higher, simply because, you know, they also obviously write a lot of options on these. All right, so why is all this important? When institutions are rotating into one sector and out of the other, the question is which stocks are going to get the most action? All right, now this is critical. You think it's going to be the smallest stock within the sector or the biggest? And again, this goes back to one thing and one thing only, and that's liquidity. So here's a snapshot of XLF. Okay, this is XLF. This was, you know, a couple of weeks ago, whenever it was. So on this particular day, XLF was down 2.89%. If you look at Goldman Sachs, which is the 5th biggest stock in XLF, it was down 3.77%. But if you look at T. Rowe Price, which is like the number, where is it? Yeah, here we go. So Goldman Sachs was the 5th biggest stock, representing 3.77%. T. Rowe Price was like, the 38th biggest stock, and it only represented 0.57%. And if you notice this, it's like, wow, financials are down 2.89%. Goldman Sachs is actually down an extra additional percentage point, okay? And T. Rowe Price is only down 0.95%. This is important to understand, because if XLF is selling off, the top 5, especially, stocks are going to be selling off typically at a higher percentage move than the sector itself. Why? Because of liquidity. That's where the volume is. And when funds got to dive in there, they got to do action, they're going to go in there in those big stocks. They're not going to be messing around with T. Rowe Price with its 5 shares being traded a day. Okay. So the good news about this is that when you get a signal on XLF, okay, and it's going to move, the top 5 stocks within that sector are going to have exaggerated moves. Okay. Exaggerated moves. So, and again, on this particular day, and you can see, and it's not completely across the board. And Berkshire Hathaway, it's a financial stock, but it's not really fair. It's more of a conglomerate. Okay, so it's kind of doing its own thing. So I actually don't really consider Berkshire Hathaway a financial stock, but it trades with the financials. But JP Morgan, oh yeah, look at this. I mean, it matched it. Wells Fargo down more. Bank of America down 5.8%. Okay, and you'll see that in general, the top 10 stocks are going to move greater than the sector itself. So goes the sector, so goes the top 10 stocks in a big way. And this really got me to thinking, when I just started diving into this, okay, when I started diving into this, this got me to thinking about how this works. Okay, because I'm not sitting, in an institution with the inside knowledge. This is just based on my observations of going, so when I see this happening, I just ask myself, okay, is it the sectors here? Is it the sectors that are driving the stock, right? Because that seems like that would make sense. Or is it the indexes that drive the sectors, first of all, okay? Or is it the sectors that drive the indexes, right? Is the tail wagging the dog here? Or do the stocks drive the sectors, okay? Or do the sectors drive the stock? I mean, it may kind of seem redundant, but I was just kind of, I'm just kind of curious. And if we look at this in a little more clean, is like if we say, okay, well, what about Apple? So Apple, okay? So Apple is part of XLK, right? And it's also part of QQQ, and it's kind of part of the SPY as well. And if we look at Apple here, so is it, is Q, when the Qs move, is that what drives XLK, right? Or is it when XLK moves, that's what drives the Qs, all right? Or is it when Apple moves, that drives XLK? Or is it when XLK moves, that's what drives Apple? And what I was looking for here is just like, there's got to be a simple way to figure out, like, who's the power here? Where is the power coming from? And I thought it was pretty obvious. I'm like, well, if the Qs are going, everybody's going, right? And what was interesting is that what we found out was actually a lot different. So the first thing I want to do is just base it on a basic setup, okay? And so for those of you that, I think most of you know what the squeeze is. If you don't, here's what the squeeze is. This is like my favorite setup. So the squeeze represents a moment in time when the Bollinger Bands, okay, if you know the Bollinger Bands, they get wide when price is crazy, but then they narrow when price gets quiet. And the squeeze just tells you, it's like, hey, the Bollinger Bands have gotten so narrow that they can't actually get any more narrow, and they need to expand again, all right? And you can see how that lines up. So that's my favorite kind of an indicator. So that's what I wanted to base it on. So I want to know is like, okay, if a stock is squeezing, how does that impact the stock versus if the sector is squeezing, okay? Or if the, yada, yada, yada. So that's the tool that we wanted to use, but we wanted to be able to cross-reference it because it's hard to stare at, a lot of different charts. So if we look at Facebook here, this is how I was doing it at first. I'm like, all right, here's a 195-minute chart of Facebook. It's part of XLK, okay, which is part of the Qs. All right, great. Let's look at squeezes. So now I'm going like, okay, here's a squeeze on the Qs. and here's a squeeze on XLK, and there wasn't really one on Facebook, and here's one here, and did that line up here? I don't know. I got to look, and it was just confusing. It wasn't, to me, it wasn't clear. So that's how I first tried to do it. I'm like, okay, cool. I'll just line them up and look. So I'm like, so that was frustrating. That was a bust. So, but when I was doing this, my original thought was, okay, logically, when an index like the NASDAQ makes a move, okay, and a sector like XLK makes a move, then would one of the top 10 holdings in that sector also make its biggest move? And so that was my first kind of hypothetical question. And so as I'm looking at this and going like, okay, so now I'm still doing it the clunky way, right? So I'm like, here's the spiders, right? So here's a squeeze in the spiders. We got a squeeze in XLK, and we got a squeeze in Facebook. Okay, it's a big move all the way around. Okay, that made sense to me. I'm like, that was not a shocker. It's like, okay, that makes sense. I just want to be able to find a clean way when these are all lining up. Okay, and this was doable, but it was a little clunky because a big part of trading is knowing how to conserve your real estate. Okay, if you're looking at 8,000 different things, you're going to have data overload and you're going to miss a lot of stuff. Okay, so I'm looking at this and it's driving me crazy, going like, all right, I'm on to something here. Or at least I think I am, but it's hard to figure out. Okay, so as I'm looking at this, and I found that even though it can be hard to find when an index and a sector and a corresponding stock are all in a squeeze together, okay, especially on a lower time frame like a 30-minute chart, at least on a daily chart, you can look at the end of the day and say, oh, wow, look at this going on. But if it's a 30-minute chart intraday, you've got to be staring at all three charts at the same time, waiting for that to set up, or you're going to miss it. Okay, but when they do line up, they're powerful. So that's what we established. When they do line up, they're powerful, but they're easy to miss. Okay, because it doesn't happen a lot, and there's a lot of other things going on. All right, so now let's set that idea aside. So my next premise was, what about just a stock? Okay, so what about just a stock and a sector together without the index? So like if Facebook and XLK squeezed together, or is it squoze, without the index, what kind of impact is that? Okay, would it be noticeably different? All right, so now we're like, all right, let's look at, well, in this case, let's look at XLF and its number one holding, Berkshire Hathaway. Okay, so not a surprise. You've got a squeeze here in XLF, you got a squeeze here in Berkshire, bada boom, bada bing, they both move. Again, not a huge surprise. Okay, now, so this made sense. So when a sector and a stock squeeze together, even without the index, they can still have a powerful move. All right, even if, and this is key, okay, even if the stock market is trading sideways, because if there's times when the S&P 500 is trading sideways, okay, but you'll also notice that during that time there may be one sector that's taking off. That's where you've got to focus the directional moves, okay, and that's where you got to find it. So this led me to my next question. What happens when a sector has a squeeze? Okay, I'm going to say this again. When a sector has a squeeze, but one of its top 10 holdings does not have a squeeze. This got interesting to me. Because what I wanted to see here is that if funds are pouring into a sector, does that drive exaggerated move in the stocks, or are the stocks just going to flop around? Okay, so check this out. So here's XLF, and again, this is the financial sector, right? And here's Goldman Sachs. XLF's got a big old squeeze and it fires. Goldman Sachs does not have a squeeze, but it is carried along for the ride. Okay, why? Because it's a top 10 holding. If XLF is going, Goldman Sachs is going. Okay, to me, this is the first thing that I realized. It's like, wow, there are stealth moves in the market that I never catch because I'm not paying attention to this. So this got interesting. So this got me interested in focusing on sector setups and then placing trades on one of the top 10 stocks within that sector, regardless if it had a signal or not. Okay. So here's Priceline. This is it's part of XLY. Okay, look at this. XLY has a squeeze. XLY takes off. Priceline does not have a squeeze, but Priceline suddenly takes off. I remember this move because it was just like, oh my gosh, this is an out of the blue move. Like, wow, what's going on with Priceline? Is there any news on it? No. What was going on is XLY was on the move, okay, and it had a signal. So I'm like, wow, it suddenly becomes very powerful because if money is flowing into XLY, then it has to flow into Priceline, one of its top 10 holdings, in a big way. Okay, so again, if you come over here and to say like, okay, look at this, XLY, look at the top 10 holding, boom, okay, and that's a top 5 holding. So then I started thinking, like, how powerful is a stock squeeze by itself, okay, when it doesn't have a sector to back it up? Because this is really how I'd been trading for a long time. I'm just looking for a squeeze on an individual stock. And this got me thinking, well, if there's a squeeze on an individual stock, how powerful is that? So here's Facebook, okay? Facebook squeeze. And if you look at the squeeze, you get in here and it's like it goes up a little bit, but if if you buy calls on this, you just get chopped up. You lose premium, you lose money. Okay. It's like, okay, so I'm like, all right, so let's take a look at this. Now, at this point, I started realizing that I was spending a lot of time staring at charts. My wife was getting upset at me. She's like, you're always looking at the computer. And it just started, I was like, God, there's got to be a way to save time. Excuse me, I'm having a sip of my kombucha here. I was like, there's got to be a way to save time. Okay, and that's really, again, what trading is that, and I always say, if you have to, oh, absolutely, it appears that the fund managers are concealing their stock purchase via the sectors. Absolutely, yes. So the key with trading is that, and here's my rule of thumb: if you have to look at a chart for more than 1 second to figure out what's going on, there is nothing going on. Okay, and that's such a key rule. So at this point, I called Eric and just said, I have a dream. I want to be able to look at multiple sectors and indexes at the same time on multiple time frames to see if anything is setting up in a squeeze together. Eric said, give me 2 weeks. Okay, and here's what he came back with. So remember that Facebook squeeze that didn't really work. Boom. So now this gets super exciting. If you remember before, I'm looking at all these different charts and trying to see, like, okay, are there squeezes here? Are there squeezes here? Are there squeezes here? So Eric is like, well, how about this? Instead of looking at 3 charts, how'd you like to look at 10 and just have all the squeezes piled on top of each other? And I was like, oh my God, that'd be amazing. And now what happens here, and you can obviously, adjust these, but right now it's like, okay, here's the spiders, right? That's the first one. Here's the Qs. That's the second one. Here's IWM. Here's the transports, XLF, XLK, XLP, XLE, XLV, and then the last one is IBB. And you can change those to whatever you want. That's what it defaults to. And it's like, holy camole, now I can look at so much stuff. So now I'm looking at this on the 195-minute chart. Here's Facebook in a squeeze. Is anything else in a squeeze? S&Ps, no. Qs, no. IWM, yeah, but IWM and Facebook, they don't really, they don't play together. And then there's energy. Is there anything in the Qs? No. Is there anything in the S&Ps? No. Is there anything in XLK? No. Look at the Facebook squeeze. It just fizzled out. I was like, okay, now I'm getting interested here, because not only is there the potential to make money on stealth moves that were happening unbeknownst to me with a lot of power behind them, but there's also an opportunity to filter out trades that actually don't have a great chance of working. Okay, because some of the best trades you take are the ones that you pass on because you can recognize that it's not an ideal setup. And I was like, oh, okay, that makes a lot of sense. So I don't know if I gasped exactly like that, but so anyway, that's the viewpoint. So now let's compare the squeeze on Facebook to another one where it had the sector and index action behind it. All right, so now look at this. Here's another 195-minute squeeze on Facebook, okay? This squeeze worked like a champ, okay? In fact, here's your entry signal here when it's at 124.50, and your exit signal isn't until it spikes up here. And that's a big move of almost $8, okay, on the stock. Percentage-wise, that's a really big move. But if you look at the squeeze and you look at this, it's like, wow, S&P 500 is also in a squeeze. The Qs are in a squeeze. And most importantly, technology is in a squeeze, okay? So that's what we call the triple squeeze. When you got at least 3 of these up here lined up with the stock you're trading, the power becomes really, really immense, all right? So I thought that was pretty exciting. So now if you look at these side by side, you can see clearly, even though if you're just looking at the chart, this squeeze looks the same as this squeeze, you can see the results on the squeeze are much more powerful because you've got the backing of indexes and sectors versus here where you've got nothing. Okay, so that's pretty awesome. Now, for those of you that are familiar with the multiple time frame analysis tool, It unfortunately looks very identical, but it's completely different. So here, just so you know, these red dots represent a squeeze, which is right here. These dots are a reflection of the Heikin-Ashi bars. And so this just simply means bullish, and this just means bearish. Okay, so they look the same, completely different. This is a bullish uptrend. This is bearish. This just means squeeze, and that means no squeeze. All right, so they do look pretty much exact, fairly close, but they are measuring something completely different. By the way, they work really well together. So then I got super excited. So with this tool, I can now look at up to 10 indexes and sectors of my choice as I'm moving through my stocks on any time frame. And this was key because sitting there and kind of flipping through, it's like daily charts is one thing, but if you want to look at 30-minute charts, you need the information fast. You need it quickly. Okay. And you can quickly see where the focused action is going to take place next. And that's what we're interested in, because it's focused concentration that causes a move. If there isn't that, you're going to trade sideways. When you're trading sideways, you want to recognize the probability of that happening. That's when you go for an income trade. Whereas if you identify these high probability moments in time of focused action, that's when you go directional. Okay. So playing by institutional rules, I wanted to get a sense of the average length of the move. Okay. So anyway, first, so that's that. We'll come back to that. All right. So the thing right here is like, great. Now we know like this stuff, right? But what I want to know is I want to be able to measure and say, okay, when this happens, where is this going to go? Okay. Because it's great to have a signal, but you've got to be able to play by the institutional rules. You've got to know at some point, institutions, a stock like Microsoft doesn't go up forever. It actually stops at a predefined moment in time. And we want to know on the institutional side, it's like, look, where is this move likely to end? Okay, because that helps us figure out what kind of option strategy to do around it. Okay, so now I don't want to get too complicated about this, but institutions are very, very big about one standard deviation moves. If you guys don't know what that is, it's not a big deal. Options are essentially priced based on what's called a one standard deviation move. And that's just a bunch of math and Greeks. And this is why that a lot of times if you buy an out of the money option, you don't make any money on it, because it's actually designed, especially if it's outside of this standard deviation, it's designed to expire worthless. So we just want to know that. So what I found here, okay, and this is important, when you have a triple squeeze type situation, okay, it'll actually tend to go to the expected move of the following week. Okay, now that was a mouthful, but if you look at this represents 4 option series. Okay, in this case, here were the options that expired in 3 days. Here is the options that expired the following week in 10 days. Here's the options that expired the following week in 17 days. And finally, the options here that expired a month out in 24 days. What I found when there's a triple squeeze, we actually can break through the expected move of the current week and go to the expected move of the following week. But at that point, the institutions will step in and defend it and push it back down, which is very, very awesome in terms of being able to set up a trade. Okay, and if you look at this XLK, when in this particular case, it was all lined up, and you can see it moved up to next week's, in this case, next week's expected move, and then got hammered. Okay, so anyway, very exciting stuff if you understand expected moves. If you don't, just understand that those lines, especially that they become good targets. Okay, same thing with the indexes and things like that too. And we'll look at some examples of that. NetEase, this was one, same thing here too. When we did this trade, this was our target on it because, look, when it got up to the expected move of the following week, the institutions are going to press it down. Why do they press it down? Because they actually are selling options outside of that. They don't want it to go beyond that move. All right, so pretty crazy stuff there. Another one here, Momo. This was a fun trade that we had there. Okay, so let's. I want to look at some more current examples as well. Okay. So the idea here with this is that when you learn how to time this stuff, you can just have an equity curve that's like that, that's a little less stressful. So let's do this. I'm going to show you, let me show you these indicators real quick, if you would like them, and how to how to get them and how to use them. And then let's spend some time. I want to answer some questions, but let's find a trade that we could do tomorrow. Okay, I want to set up a trade tonight with you live that we can do tomorrow. So what are these indicators? Okay, so if you go to simplertrading.com/shadow, and again, I know some of you guys and a lot of you already have these indicators, so you can ignore this part. But I want to show you some live stuff here too. But if you don't have these and you're like, you know what, that looks pretty awesome, I think that'll help my trading. If you go to simplertrading.com/shadow, we have not released these indicators before. These were included as part of a class that we did recently. But this triple squeeze is going to be $597 on our site, and the expected move target is going to be $397. So I don't know what that adds up to. 597 plus 397. That looks like, let's call it 6 plus 4. So that looks like about $1,000, right? It's like, that's a little pricey. So we do, when we release these together like this, like to give you a chance to just like, hey, here's a discount if you want to do it. So we're going to do those two indicators plus a free full day of live trading, which we'll do on the 27th. And so you can get the, essentially $1,000 worth of indicators plus a free day of live trading for $697. And you'll get the indicators. You can load them up on your charts and start using them on Thinkorswim or TradeStation. And then from there, we'll spend the day together on April 27th, next Thursday, trading these things live. Okay, and with these trades on here, look, I'll just show you right here. CMG, this has been a very powerful directional trade. Nice little home run there. Apple, because of the chart, we're doing income on it. Okay, nice income trade there. Let's see, Alibaba, nice income trade there. Microsoft, beautiful income trade there. Nvidia, beautiful income trade there. So we define these on income versus directional based on this stuff. Okay, and then last but not least, just real quick before we dive into this stuff, is that if you like the idea of live trading in Austin, we are going to be doing a live event June 12th to the 13th in Austin. If you're interested in going to this, you can call the office here, 512-266-8659, and I believe that they can actually hook you up with the indicators. All right, so anyway, so there's all that. So let me put this back here. Let me answer questions, and then let's dive in here and find a setup for tomorrow, okay? So is there a scan for the triple squeeze? So we're actually, it's one of those things too, if you guys have the scanner, we've been utilizing that as well to kind of get those integrated in there, kind of that nice double whammy there. Are you using these in the trading room? Yes. So by the way, when I'm in the trading room, I'm sharing one monitor. I've got 6. And so I'm dragging all these different things around, but this is the basis for I'm using a lot of the trades that I've done this year. Oh, is the squeeze always bullish? If not, how's it different? No, it's bullish and bearish. So let's I'm just going to do the questions real quick, and then we'll start looking at some live stuff here. Yeah, Marco. Yeah, certainly call the office on that. Okay, so they can take care of you. Yeah, so let's look at a couple of things here. So if you're doing futures, so a couple of things here. So if you're doing futures, okay, so let's say you're doing the S&Ps or currencies, and let's do this on a daily chart. So here's the S&Ps, and in this case, I've got them lined up with other futures. And this is great for correlations. So you can see here, it's like, okay, Aussie dollar, natural gas, bonds, and you can change all that, right? So you can see right now that the S&P futures and the NASDAQ futures are in squeezes, but the rest aren't. Well, if you start seeing that like the yen is correlating, guess what? The yen squeeze can be pretty powerful. So if we go over here, say on a 30-minute chart, okay, and you can see, look how fast this does it. Now, sometimes you'll get some weird stuff because of different trading hours for some of the different futures. But you can see here, it's like, wow, man, on some of this stuff, we're getting some 30-minute congestion here, and that's great. For stocks, what I like to do here is now this one for the expected move, okay, and this is goofy right here because of futures. So let's make this, oh gosh, which one I was looking at here? Facebook. We'll go back to Facebook again. So what's interesting here with Facebook, okay, so Facebook is now just setting up. So I've got here a 2-day chart, a daily chart, and a 30-minute chart. The daily chart is where I spend most of my time. So if you look at this on Facebook, look what's setting up right now. In fact, let's set up this trade right now. So on Facebook, we have a squeeze on Facebook. We've got a squeeze on the spiders. We've got a squeeze on the Qs, okay? And we got a squeeze on XLK. Now, my rule of thumb here is if it's above, at the time that this is setting up, if we're above the 21 period exponential moving average, assume it's going to trigger long, okay? You don't want to counter trend trade. So, and in this case, and especially on a rally in the earnings, the potential is that it's going to go to next week's expected move, okay? And so what I do on this then is I like to, because these expected moves will move, oops, and everything's gone. Thank you very much. So the expected moves here, they'll move each day just based on, so what I do is on the time of my entry, I mark them. In this case, since I'm looking for an upside move, okay, I'll mark multiple targets because I know that's where the funds are going to defend them. So we're currently at 142.27, so we got 145 as a potential target and a stretch target 147.92. And so now I can come in here and say, all right, so we'll do one bearish trade and one bullish trade here. So now I can come in here and just say, okay, this is great. On Facebook, now I don't want to buy an option that expires this week. I want to give it a little bit more time. And you can see that right here, earnings are right here. You can see that high implied volatility. So I want to buy options on it for, like right here. So we're at 142. In general, I just default and go in the money. So 140. So you can see we're 290 by 310. So I'm going to place an order right now because I want to buy these tomorrow. I'm going to place an order at 270 and see if we get a slight dip in the morning. If we do not, I want to make this good till cancel. I'll get a little bit more aggressive. And then I already know if I get filled, okay, if I get filled, where my targets are, okay, because of this tool. So I think that's fantastic. Now, this being said, let's go ahead and look at some potential bearish trades, okay? Because it's easy to always, oh yeah, bullish trades and yada, yada, yada. And there's a lot of interesting kind of bearish potential trades setting up right now in the financials, okay? And so what I want to do then is come and look at the financials and just say, all right, for the financials, what's going on here? Is there anything here that is shaping up? Is there any multiple squeezes setting up, especially in the top 10 stocks? And so let's go and look at Bank of America. All right, if we look at Bank of America and we come over here and say like, okay, well, there's a squeeze in Bank of America, squeeze in spider, squeeze in the Qs, and there is a squeeze in XLF because it's below the 21. I'm looking at a bearish target and I'm looking for a move back to $22. So boom, we'll come over here and just say, great. Let's bring up this and say Bank of America, again, going out 9 days. And this is the stuff I'll do during the live class. Obviously, when the market is open and we get a lot more time to spend together, this will be a lot easier. But I'm going to go slightly in the money here and buy these puts. Okay, and let's just in case we get a little bit of a gap up here, let's do $1.25. Good till cancel, and we know what the targets are. Okay, so it can be that easy. And then when you have mixed signals, then you do more income type trades. All right, so anyway, that's kind of the stuff I'll be doing during the live trading class as well, and just showing you how do I find this stuff. What are we looking for and stuff like that too. Okay. All right, so what questions do you guys have? Again, this is our first release of these indicators. And if you already bought them, by the way, or you already got them from the last class, no worries. You can join us on this as well. If you don't have these and want to get them, this will be your discounted opportunity to get them. These things will pay for themselves multiple times over. They just really help kind of keep you on the right path there, okay? All right, let's see what questions you have. If a stock has a squeeze fired, does its index sector have to have their squeeze fired or just in a squeeze? Pat, great question, and it's okay if it's just in a squeeze. That's kind of like added. That's actually, I like seeing that because the individual stock is triggered, but the sector has not yet triggered. Just think when that sector triggers, that stock's going to take off. So I actually prefer that. How do you use the indicator for the projecting of the targets? Well, if you look right here, I mean, essentially what you do is you use this from the moment you get in. This is going to tell you like, okay, first of all, this is your expected, your normal target, you know, in this case, 3 days out, 11 days out, you know, based on the option series. So that's how, you know, that's just kind of where you can kind of at least, you know, decide what type of thing to do. What I've noticed though is that when you've got a sector and a stock together, they'll actually bust through this one and get up to next week's expected move. But you got to understand when it gets there, it typically gets killed. So not only can you take profits there, but you could actually, if you're a more advanced options trader, sell call credit spreads there in that case and play it on the way down. Yeah, so how do you figure out whether to do a, you know, directional trade or an individual trade? So one of the things I've been doing there is like if you look at something like Apple, right? So on Apple, you'll notice that, you know, we've got some sectors, you know, kind of setting up here, but Apple doesn't have a squeeze. So when I see that, all right, I'm like, okay, well, especially on a bigger stock, typically you're just going to trade sideways for a little while. So that's the kind of stuff that I like to look at there, and that becomes more of an income trade opportunity. So it's nice because it really, once you get the hang of it, which I'll show you during the live trading, it's pretty clean. You just look at something and say, oh, that's an income trade. Let's set an iron condor on it. Okay. Oh, no, this one's a directional trade. So, you know, let's do it this way. It is dynamic, Sean. So what you want to do is the moment in time that you're getting into the trade, I then draw horizontal lines in here so I can lock those levels in. Does that make sense? Because you want them based on when you get in. Let's see. Yes, the 140 call on Facebook. Oh, sure. Here, let me post these trades in the chat. Or can I post these in the answer by text? Yeah. Here, I'll place a notepad here. And there we go. And then of course this will be, you know, we'll do a lot during the, so my goal even though it's a 1-day live trading class, is my goal typically in a class like that is that you're actually able to pay for the indicators in that class, utilizing the trades that we set up. So that's the Bank of America one. And the Facebook one. Okay. Yeah. So now for day trading, I actually don't like using like say a 5-minute chart, but if you are into that, this gives you an edge because you can just drop this to a 5-minute chart and look at this. You can see the sectors when they're all setting up on a 5-minute chart, which becomes very powerful as well. So I got really excited about that. Now again, 5-minute charts don't really float my boat very much, but you know, I'll do 30 minutes and above because I like to look for something that's, you know, slightly bigger move. My ideal holding time is I get in on Tuesday, get out on Thursday. So I like 2 days to like 2 weeks. That's kind of my sweet spot. When you draw the lines, you use the expected move at the time of entry. Yes, exactly. Are the expected move targets based on fibs, or how are they generally determined? So they're actually based dynamically on the implied volatility of the option series that you're trading, okay, and they lock in the expected move. So now what's interesting is that a lot of times Fibonacci levels will line up with it, but this is literally telling you where the institutions will defend their options that they sold, and they'll push the stock either back down on an up move or on a down move, push it back up. Will the 27th be recorded? Yeah, absolutely. Yep. If you can't attend it live, there's still a lot of value in just seeing how to set this stuff up. Spot currencies, yeah, I love the squeeze on the currencies. I'm watching on the dollar right now is setting up a weekly squeeze, which obviously is going to have a big impact on all the dollar crosses. Yeah, Les, just give us a call here. That's a good question there. So you can call us here at 512-266. All righty. All right. I think that is. Yeah, so do you use the expected move and combining with earnings play strategies? Yeah, we did actually a trade on eBay today on earnings. So if you look at eBay here, so eBay, and you can see here's the expected moves on eBay, right? So when we went in to set that up, and there's eBay. So you can see how I set this up based on earnings is I set it up based on those expected moves. So I sold the 34 calls and 34 puts, and you can see the expected move was $1.70. Looks like after hours is it might open flat, which would be great. That's how we priced it. So yeah, I've been using them for earnings too. If you know your target, can you set up the closing trade when you place the opening trade? Absolutely yes, and I highly, highly, highly recommend it. Set it and forget it. Because what happens sometimes, especially with stocks, is they'll spike into a target, and then guess what? They immediately sell off. And so if you happen to be like in a meeting during this time, and you're like, oh, it's going up. I wonder if it's going to hit my target. You go to the meeting, and you come back, and it's hit it, and now it's down here. That is so frustrating. So please, please, please place your orders in advance like that. It's so nice, and I love it when I'm sitting there and I get an alert on my phone. It's like, think you have been filled, and that's great because then you don't have to sit there and stare at it. Are there default settings that come with the indicator, i.e. sectors chosen? Yes, Gary, but it's easy to change them. So you'll see that when the default is, if you go in here and you look at the indicator, edit studies, and triple squeeze, you'll see that it defaults, but then you can easily change them. And by the way, you don't have to look at 10, just leave it blank if you just want to look at a couple. So it defaults to the ones that I like, but you can tweak them and change them and stuff like that. For an entry on the squeeze plays, do you typically just wait for the squeeze or sector to fire? I actually try to get in early. So if it's a squeeze is setting up and it's above the 21 period moving average, I will try to buy pullbacks to the 21 while it's still in a squeeze. And I found that works great. Now, if you're not sure, you can wait until it triggers. But typically when it triggers, it's off and running and it can be harder to get into. But it's fine to do that. All right. Yeah, no, thank you, Danielle. I see Danielle just firing off all the questions there. That's awesome. This may be a dumb question, but how do institutions push down a stock to defend a position? Okay, so no, not a dumb question. So let's say that you're an institution and you sold, 5,000 naked calls, on Facebook at 143. Okay, so 5,000 naked calls or 5,000 calls represents 500,000 shares of stock. And if Facebook blows up through that level, they're going to lose a lot of money there. So what they do is like, okay, it gets up to 143 in this case. Those are the calls that they sold. They can just start selling the stock. Now remember the stock, so shorting it essentially, or unloading some of their positions, just to keep downward pressure on it, because they sold 5,000 options. In this case, if they sold 5,000 options for $2, well, that's a potential $1 million. If I'm doing my math right, that's $1 million in premium. So it's worth it for them to like, all right, I'm going to short some stock and push it down to, if it's at 143.40, we're going to short some and sell it so it gets down to like 142.75, right? So that these expire worthless. They keep that money, and then they can work their way out of that. Now, is it a tricky game? Yep. But do they do it? Yep. All right. Will this work if I live in Australia? Yeah. So I'm assuming if you're living in Australia, you're probably not staring at the markets all day. But you can just use this on daily and weekly charts and just set your orders like I just did. Like I just set these orders right here. All right. Right. I think that's cool. All right. Good stuff. Yeah, Bill. Absolutely. You'll get some information on that. Okay. So good deal. Okay. So what I would, so if you're intrigued by this, I mean, look, I think this is super valuable. You can see the results of my own trading. I think these indicators will pay for themselves very quickly. So if you're intrigued by this, I encourage you to go here, sign up for the indicators, and then join me for that free live day of trading on April 27th, and I'll show you exactly how I use this kind of stuff, and we'll go from there. All right. So that's what we got. I didn't want to take up more than an hour of your time, and we're at an hour. So I will leave this up here. So if you guys have any questions, but otherwise, thank you so much for joining us. And I've got these orders working here for the trades. For those of you in the room, we'll see you tomorrow. For those of you that are interested and excited about these indicators, I hope you are. As a trader, I love finding really good tools, and these are awesome. And they've made a nice, clean difference in my trading this year, and I hope they do the same for you. And you guys have a fantastical evening, and see you on the other side.